Michael Burry warns QT might cause higher inflation shock. All the silliness must go. The Big Short investor Michael Burry was right all of 2022. If only we had the wisdom to listen and act accordingly, many of us would be in a much better position. He is the gift that keeps on giving this year. He recently tweeted lots of gems, one of which is about money velocity. He is showing us, despite the Fed's rate hikes and quantitative tightening, money velocity actually went up recently. Shocking, right? What's more shocking is he said it's going to drive the current inflation even higher, which sounds absurd because what the Fed is trying to do is lower the inflation down. At this time, we still do have indicators to believe that inflation is still a major problem. That's the reason why the stock and bond market printed a record low year to date this week. And Michael Burry is right about this. I will tell you why Michael Burry is right and why the market will go lower right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. You know what to do. Push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a sweet boy, go to patreon.com/magicalgoddesscheryl to support all my work. If you want to be my good boy, apply to write your first book with me, author of best-selling books, Goddess Cheryl. My good boys always obey and they always get rewarded handsomely. Have you been a good boy? You will get the encouragement you need to be on your author journey. Let's just dive right into it deep, this time into the rabbit hole. At first, he said that everyone is predicting deflation because all of the obvious signs it is coming. And the rates are still rising fast across the curve. What does that mean? Okay, let's pause here and look for the deflationary signs we can find so far in the markets. We just had a 25% down in the S&P 500 and had a kiss of death confirmation. That's deflationary psychologically. It might bring down wealth effect. The rich won't spend as much on shopping in the real economy because they might be busy buying stocks when the market continues to fall. Gold is only down close to 20% from the all-time high. Gold was down 33% in 2008, and it was down to $678 per ounce. Now it's traded at $1,660 per ounce. That's more than doubles the worth. And this is just paper gold, not real shiny gold. So we actually see inflation from gold, not deflation. Let's look at Dr. Copper in 2008. A real deflationary crash, copper future fell 69% to $1.3 per pound. Even in March of 2020, it was down to $2 per pound. Now it's still at a very high level at the top of the box, as you can see from this chart. Copper really can't make the case of deflation at the moment. Let's look at long bond TLT. Last two times we had deflationary crash. We had TLT spiking higher, almost 37%, but it didn't start spiking until the middle of November of 2008. So we might still have time to see TLT going up while the stock's going down if the Fed keeps on tightening. But the thing is, TLT keeps on making new lows right now. Didn't even form a bottom yet. Anyway, back to Burry's tweet. Must be QT kicking in. September is the first $90 billion a month. I think what he means is in the past two deflationary crashes, both in 2008 and 2020, when rates peaked and starting to drop lower, that often signals deflation is coming. And this time, all the rates or yields are still rising fast, signaling inflation is still very hot, as we can see from the US core PCE inflation data. Check it out. The Fed's preferred measure of inflation, stripping out food and energy, personal consumption expenditure rose to 4.9% on the year. From the same month a year ago, food prices in US increased 12.4% and energy prices increased 24.7%. Normal times without any inflation core, PCE is around 1.5%. As you can see when you look at in the 1970s to 1980s, core PCE is at 9 to 10%, which is even worse. That brings us to the second tweet of Michael Burry. He said velocity is nominal GDP divided by M2 money supply here. QT plus higher rates starting to push M2 down, yet we are seeing a tick up in velocity, emerging from narrative obscurity. In 1978 to 79, rising velocity trumped falling money supply to drive inflation higher and higher. Redux would shock, meaning he believes what the Fed is doing QT and keep on raising rates are essentially driving the money supply, or you can say credit, in the system lower, which drives money velocity higher based on math. In the 1970s, rising money velocity drives the inflation higher. So this time, if inflation going higher from here, as the rising yields suggest, people would be shocked. That's why Brainerd warns against retreating from inflation fight prematurely. Fed Vice Chair Brainerd warns against retreating from inflation right prematurely. Federal Reserve Vice Chair Lael Brainerd on Friday stressed the need to tackle inflation and the importance of not shrinking from the task until it's finished. Monetary policy will need to be restrictive for some time to have confidence that inflation is moving back to target, the central bank official said in remarks prepared for a speech in New York. For these reasons, we are committed to avoiding pullback prematurely. The remarks came a little more than a week after the Fed enacted its fifth interest rate increase of the year, pushing its benchmark fund rates to a range of 3% to 3.25%. September's increase marked the third consecutive 0.75 percentage point increase for a rate that feeds through to most adjustable rate consumer debt. While Fed officials and many economists expect that inflation may have peaked, Brainerd warned against complacency. Inflation is very high in the United States and abroad, and the risk of additional inflationary shocks cannot be ruled out, she said. Early Friday morning, the Commerce Department released data showing that inflation continued to push higher in August. As measured by the Fed's preferred personal consumption expenditures price index, core PCE increased 4.9% year over year and 0.6% for the month, both higher than estimates and well above the Fed's 2% inflation target. Since the Fed has hiked rates, Treasury yields have soared, and the dollar has increased in value rapidly against its global peers. Brainerd noted that ramifications of a higher U.S. currency, saying that it is exerting inflationary pressures globally. On balance, Dollar appreciation tends to reduce import prices in the United States, she said, but in some other jurisdictions, the corresponding currency depreciation may contribute to inflationary pressures and require additional tightening to offset. The Fed is far from alone in tightening policy, as central banks around the world have been raising rates to combat their own inflation problems. However, the Fed has been more aggressive than most of its peers, something Brainerd noted could have spillover effects. Now you know why Michael Burry is right about inflation, and why the Fed needs to push the stock market even lower to fight inflation. Okay, now I'm going to show you my client Juliana Wood's book. It's called Burning in the 2020 Flames. And I'm going to show you Teddy Eazzy, my client Teddy Eazzy, Wicked Pussy Perfume. This is an erotic novel. And my book, Joy, the Spell of Magic. This one is a bestseller. And Believe in Yourself, Sweet Candy Dreams is such a Halloween treat, another one of my books. And You Hold the Magical Key to Your Success, another one of my books. These books are so amazing. Please order your copy today. So these books help with depression, anxiety, and stress. We are living in uncertain times, and these books will actually help to uplift you and motivate you to become the best version of yourself and to achieve those dreams of yours. So I thank you for liking my video and subscribing to my channel. Bye.